After more than 3 years of higher interest rates, it now appears likely that we're finally going to get some interest rate cuts soon. This is coming after Jerome Powell recently gave a speech in Jackson Hole where he indicated that rate cuts were likely to happen later this month at the next Federal Reserve meeting. Although there was recently some negative news about inflation picking back up, it still appears likely that the market anticipates there being a cut coming. And if we do get a cut in a couple of weeks, it's going to be beneficial for the vast majority of stocks and diversified investment funds. Although the lingering question that's still yet to be answered is how aggressive will the Federal Reserve be at cutting rates? If I had to guess, I'm going to assume that we're not going to see any dramatic cuts coming because Jerome Powell has historically been very conservative on this. Regardless, even if there is just a small cut, like 25 basis points, that'll still be good news. Most companies are going to be better off, even with just slightly lower interest rates. So in this video, I'm going to talk about several different investment types that stand to benefit the most, in my opinion, from lower interest rates, and I'll explain how they'll benefit. Like I just said, most investments will be better off, even with just slightly lower rates, due to reasons like cheaper borrowing costs and more interest in the holdings I'm going to talk about. If you haven't already seen it, then feel free to check out last week's video, in which I discussed several investments to avoid after rate cuts happen. But in this video, I want to highlight specific investments that have been struggling ever since rate cuts went into effect, which will do better if we do get some meaningful cuts. So with that being said, let's get started. The first investment type that's going to benefit from lower rates is going to be real estate investment trusts. REITs are companies that buy real estate properties and pass the rent payments on to shareholders. Normally, REITs don't offer high yields. Before interest rates started going up, many REITs only offered yields of around 1 to 4%. But these investments struggle when rates are high, and the market started selling them off all the way back in 2022. The reason for this is because REITs are required to pay 90% of their earnings to shareholders in the form of dividends. So because of that, all of these companies primarily grow through taking on debt to acquire more real estate properties. But because debt is so much more expensive, it's resulted in a lot of these companies slowing their growth. Now that rate cuts appear to be coming soon, that should result in many REITs growing back in share price as they become more appealing. So now is a good time to buy discounted companies in this sector, while many are still offering abnormally high yields of 5 to 6% or more before their share prices start going up. REITs also typically offer regular dividend increases, unlike other higher yielding assets, so if you want some growth in your portfolio, then REITs are going to be where it's at. Again, it's going to depend on how many rate cuts we get and how severe they are, but even small cuts will have some benefit. And not every company in this sector is still currently on sale, but many are. Still, one of the best choices in my opinion is going to be Realty Income. Their stock was trading for nearly $75 a share before rates started going up, and the company has only grown a lot since then. It pays monthly dividends, and they've increased their distributions 4 times a year for the last 27 years and counting. It's already up almost 12% in share price this year as the market is finally coming around to them again, so this should be a trend that continues. Another dependable stock yielding over 5.5% is Triple N REIT. Much like Realty Income, Triple N has grown their dividend every year for decades. Their properties continue to have high occupancy ratings and their dividend payout is very conservative. Less than 2 months ago, they just increased their dividend by a higher amount than usual. But this sector overall will enter a much better environment going forward if we do get some meaningful rate cuts. As a side note, mortgage REITs in general will also do better in a falling rate environment, which will provide some relief for these companies. A third investment type that'll benefit from rate cuts are going to be funds that hold fixed-rate debt, such as closed-end funds that hold bonds. That would include CEFs that hold assets like high-yield bonds, emerging market bonds, agency mortgage-backed securities, and commercial MBSs. There's an inverse relationship that exists between interest rates and the bond market. It's not 100% perfectly correlated, but historically when rates rise, then bond values fall. And when rates started going up in 2022, it negatively impacted bond prices. In fact, 2022, as many of us are aware, was the worst year in history for the US bond market. If you invest in a lot of closed-end funds, you likely notice that their NAVs and share prices fell in 2022, and many have been struggling since then. But despite this, most haven't gone through dividend cuts, so many of these investments are still yielding well over 10%. When rate cuts go into effect, then fixed assets will rise in value because they become more appealing to investors. And in fact, with these funds that hold fixed rate debt, they can actually earn more money when rates are higher for longer. As older bonds in these funds reach maturity, then these funds use the proceeds to buy new bonds, which now come with higher yields. There's a number of closed-end funds out there that hold fixed income investments that are still offering really good yields. The company PIMCO has a number of funds that offer really attractive high yields, and they all pay monthly dividends. The PIMCO Corporate and Income Opportunity Fund, ticker PTY, is one of those options. It holds a lot of different fixed assets, and it offers a yield of well over 10%. There's also a slightly different fund, which is PDO, the PIMCO Dynamic Income Opportunities Fund. This one is still relatively new, having been around for only a few years, but it currently yields over 11% as of the making of this video. Then there's also the PIMCO Dynamic Income Fund, ticker PDI. As you can see, the names of these funds are pretty similar to one another, but they do differ slightly when it comes to asset allocation and their use of leverage. There's other fund providers out there like Naveen, Eaton Vance, and John Hancock that offer similar closed-end funds. Another investment type that will also do better, although I'm not expecting them to perform as well as what we've covered up to this point, is energy companies. The reason why I don't believe they'll do as well is because many of these companies still do pretty good when we're in a higher interest rate environment. This is because most energy and utility companies are seen as being very safe. People still need electricity and energy in general, no matter how the economy is doing. And people are also drawn to their dividends, which are higher than most stock sectors. So not every energy company right now is still a good deal. But understand that energy companies borrow large sums of money because they have expensive infrastructure. Oil pipelines, cell phone towers, and power stations are all very expensive to build, maintain, and upgrade. Just like with REITs, when rates do get cut, they'll be able to expand and upgrade their operations more efficiently. However, because they're viewed as safer, many have run up in share price, and some of my favorite energy stocks and closed-end funds that hold energy companies have really ballooned in the past year. But some are still appealing in this sector, including a handful of master limited partnerships. Although they will issue you an extra tax form that you're required to file with your income taxes, they're still very likely to do well and keep growing their distributions. 3 solid MLPs that exist are Energy Transfer, ticker ET, MPLX, ticker MPLX, and Enterprise Product Partners, ticker EPD. All 3 have really solid track records of both high yields and growing their distributions over time. There's more MLPs out there that exist that are really good, but these are some of the best in my opinion. But in general, energy and utility companies should do well when rates go down. And like I said, how big the rate cuts will be is going to determine the impact of how well these companies will benefit. If we get one small cut and then that's it for the year, then the impact won't be too significant. But hopefully we will get a moderate amount by the end of this year. But feel free to let me know your thoughts, and with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.